We often talk about insuring ourselves, our health, our home, our ability to earn a paycheck.
hmm
But if you're running a business or you're part of an executive team, there's this huge blind spot that can just sink an entire company.
And that's the real question. What happens when the one person whose skills drive the whole operation is suddenly gone?
Exactly. We're so focused on our personal income. Today, we're talking about insuring the company itself.
That's a crucial distinction, and, it really sets the mission for this deep dive. We're going to cut through the very specific world of business risk insurance.
Okay.
We'll show you how different structures like key person coverage, these specialized health trusts, and some unique grouped plans are all used to protect the business entity, its cash flow, its stability.
And we'll get into the surprising rules, especially around tax.
Oh, that's where it really hits home.
Okay, let's unpack this by starting with key person insurance. This sounds like the ultimate corporate safety net.
It can be.
When we say key person, we're not just talking about a job title, are we?
Absolutely not. A key person is someone whose skills are so critical they are genuinely difficult or even impossible to replace in the short term.
So their absence just creates this immediate massive hole.
A huge gap in the company's ability to make money or even just operate day to day.
Can you give us some examples of that kind of role?
Sure. And think beyond just the owner or the CEO. It could be the lead systems designer who holds all the proprietary knowledge.
The one person who knows how everything works.
Right. Or a highly specialized technical expert, maybe the Salesforce trainer who's the only one that gets new hires productive. Their contribution is unique.
And the source material explains that key person policies, they aren't just one thing. They can be structured using life insurance, critical illness or a CI, or disability insurance. We're focusing on productivity, so let's stick with the disability insurance side. The core idea is always to protect the employer.
Correct. The benefits are paid directly to the business. That cash flow is meant to offset very specific, very measurable losses.
Like the immediate drop in productivity when that person is gone.
That, but also the ripple effect, the drop in effectiveness from other employees who relied on that person's leadership or skills.
And then there are the direct costs of just managing the crisis.
Exactly. You lose sales, you lose contacts, and then you have the heavy, heavy costs of recruiting a replacement. It takes time and money just to find someone who can even partially fill that role.
Okay, here's where I want to pause. A listener who owns a small company might just assume, okay, I'll insure myself, the 100% owner. What are the rules on that?
That's a great question because it really speaks to the intent of the policy. Insurers, they put restrictions in place to make sure it's protecting the company's operations, not just, funding an owner's retirement.
So there are limits.
Yes. The sources show that carriers generally put maximum limits on ownership stakes, often somewhere between 10 to 50% of the business shares.
Wait, why that cap? Why wouldn't they let a 100% owner who is undeniably the most critical person get this coverage?
Well, if the individual is a 100% owner, the risk assessment completely shifts. The insurer sees that as an attempt to replace the entire profit function of the business, which is really better handled by other things like business overhead expense coverage or BOE or even just a personal DI policy. Key person insurance is designed to protect the entity from the loss of an employee's services.
That makes the signs and lines example from the source material crystal clear. They had Mona, their graphic designer. She wasn't an owner, but she drove 45% of their annual revenue. So the owners took out a policy on her for $12,500 a month.
And that monthly injection of cash, that $12,500, was specifically calculated to cover the fixed overhead and the salaries for the other two production employees.
So the business didn't implode while she was out.
Exactly. It was there so they could survive while Mona was recovering or while they were hunting for her replacement.
Okay, moving into the mechanics. The definition of disability is usually tied to their regular occupation, right?
Meaning the inability to do the job the business needs them to do to stay profitable. And because the business needs that protection right away, these are very short-term solutions.
Short waiting periods, then.
Very short, typically 30 to 90 days. And the benefit periods are also short, rarely more than 12 months.
That benefit period limit, that really speaks to the reality of this situation. A business can't just wait forever.
No. If they can't find a replacement within a year, they're probably facing much deeper, more strategic problems. The benefits are just a bridge.
A bridge to stabilize cash flow and cover recruitment.
Exactly.
Now let's talk tax, because this is what you called the critical distinction earlier, the key person tax flip.
This is non-negotiable. Anyone advising or owning a business has to understand this.
Okay.
The employer owns it, pays for it, and receives the benefits. So here's the surprising rule.
Okay.
Premiums paid by the employer are not tax deductible.
Okay, so the business pays that with after-tax corporate dollars. It takes the tax hit up front. What's the trade-off?
The trade-off is enormous. The money received by the employer when there's a claim is completely tax-free.
Ah, I see.
The logic is, well, since the premium wasn't deductible, the payout is just a recovery of capital. It's not new business income. So that makes it incredibly efficient cash flow during a crisis.
And the benefits are usually capped, right? Around the employee's salary.
Correct. Up to maybe $15,000 a month, though you can add riders for things like replacement expenses to boost that payout. It's meant to minimize loss, not create profit.
Let's transition now. We've talked about insuring the business itself. Let's look at plans the business uses to provide benefits to its employees, often for a tax advantage.
Right. So we're shifting from protecting the business's cash flow to managing employee expenses and their income.
So first up on the health side, employee health trusts, or EHTs.
EHTs, yes. They replaced the older health and welfare trusts back in 2022.
And these are generally for medium to large employers. Why the focus on size?
They're just complex, administratively costly to set up and run. But for those bigger companies, the tax perk is fantastic. Employer contributions are fully tax deductible.
And for the employee.
Not a taxable benefit.
And the money has to be used for group health premiums. The employer can't just claw it back.
That's key. It's non-refundable. It ensures the funds are permanently for employee welfare.
Now let's contrast that with personal health spending plans, or PHSPs. These sound like they're for the little guy.
They are, designed specifically for sole proprietors, partners, and their families. They cover things that qualify for the medical expense, tax credit drugs, vision, dental.
So it's a clean way for a small corporation to pay for the owner's personal health needs with pre-tax corporate dollars.
It is. But there are limits.
What are the limitations?
Very specific annual caps. $1,500 a year for owners and adult family members, $750 for minors.
Right.
And you have to use the money within 2 years or you forfeit it.
So you can't just use it as a secret savings account.
Exactly. It forces you to use it for healthcare. But the tax advantage is great. The corporate contribution is 100% deductible, and it's not taxable income for the employee.
Except in Quebec, provincially.
Except in Quebec. Good catch.
Okay, we've covered health expenses. Now let's pivot to a crucial structure for disability income, the grouped plan.
A grouped plan is, it's an interesting hybrid. It's where an employer buys and holds individual DI or CI contracts for 2 or more employees.
Instead of one big group policy.
Right. You get the efficiency of group purchasing, but with the customization of individual contracts.
And what are the setup rules?
2 critical ones. First, the employees have to be in a defined class. You can't just cherry pick.
And second,
the plan can't be made up exclusively of shareholders. Shareholders who are also employees can be in it, but they can't be the only ones.
this brings us to another major tax structure, and this one is the total opposite of the key person tax flip.
Completely different. This is the structure that transfers the tax liability to the employee, but only when they make a claim.
Okay, so walk us through it.
In a proper group DI plan, the employer can tax deduct the premiums they pay.
Good for the business.
And the employee does not report those premiums as income, so they get a tax-free benefit up front.
That sounds fantastic so far. What's the catch?
The catch is the claim. The moment the employee claims benefits, that money is taxable income. The government's logic is, we let the employer deduct the premium, so the benefit is just replacement salary.
And that is so vital for calculating true net income. The example was Hans, who got $3,600 for a knee injury.
Mm-hmm.
He had to include that full amount as taxable income. If he was expecting $3,600 net, he's in for a shock.
A huge shock. If Hans is in, say, a 35% tax bracket, that benefit is really only worth about $2,300. If his bills required the full $3,600, he's in a serious shortfall.
You have to gross up the benefit amount to account for tax.
You absolutely have to.
This reality brings us straight to our final and probably most challenging topic, coordinating all these different layers of coverage.
Seriously.
Yeah.
Think about it. You've got individual policies, BOE, key person buyout policies. It's a huge logistical puzzle.
And the goal is to prevent gaps, or worse, expensive duplication.
Right. And the most common vulnerability we see is what I call the owner-operator gap.
You touched on this earlier.
Yeah. If an owner-operator only has key person coverage, the business might survive, but their personal income is toast.
And the reverse.
Conversely, the sole proprietor with only a personal policy has their income covered, but they might come back to a business that's collapsed because they had no business overhead expense insurance, no BOE.
Let's define BOE quickly, since it's so key to this puzzle.
BOE insurance is designed to reimburse a business for its fixed operating expenses while the owner is disabled. It pays the rent, utilities, staff salaries.
The bills that don't stop just because the revenue did?
Exactly. It's different from key person DI, which covers lost revenue. BOE covers fixed expenses.
Okay, let's pull this all together with the Carly example.
Okay.
She was a co-shareholder, and she thought she was totally protected.
Right. She had 3 corporate layers. Key person for the business, buyout policies set to kick in after a year, and a corporate salary continuation plan.
And the problem was with that salary plan.
Her salary continuation plan paid 50% of her income, but it had a 90-day wait and only a 9-month benefit period. And the fatal flaw...
It was taxable.
It was taxable to her, so her after-tax income just wasn't enough to live on, especially since the buyout policy didn't start until day 365.
So the solution was integration, layering different policies to fill very specific gaps.
Exactly. She needed a supplemental personal DI policy, one she owned and paid for privately.
Why privately?
So the benefits would be tax-free. She structured it to pay a high amount, say $10,000 a month for the first 60 days to cover that initial period before her corporate plan even started.
And
then it dropped to a lower amount, maybe $5,000 a month, for the next 10 months to top up her taxable corporate income until the buyout finally triggered.
that strategic layering is the only way she could get to, say, 85% of her pre-disability income, no matter what the tax or waiting periods were.
Which leads to the final warning. You can overinsure. Most plans have an all-source maximum
They cap your total benefits.
at about 85% of your pre-disability income. If you go over that, the secondary plans will just reduce what they pay you. You can't profit from being disabled.
That 85% cap forces you to be strategic.
It does. So, to summarize this whole deep dive, I think the single most important lesson is that the structure of the policy, who owns it, who pays, who gets the benefit, that's what dictates the tax outcome.
And that tax outcome is the difference between being covered and having a huge shortfall.
It's everything.
And if you walk away with one technical point that always surprises people, remember this. Key person premiums are not deductible, but the benefits are tax-free to the business.
And conversely, grouped DI premiums are deductible by the business, but the benefits are taxable income to the employee.
Two sides of the same coin.
And that leaves us with a final provocative thought for you to consider. We established that disability benefits paid to a private corporation, like that big tax-free key person payout, they do not generate a credit to the corporation's capital dividend account, or CDA.
Right, and just to quickly define that, the CDA is the special account that lets a private corporation pay out certain tax-free amounts to its shareholders as tax-free dividends.
Precisely. Since key person benefits don't create a CDA credit, if the corporation just hands that cash to the owners as a dividend, it's fully taxable. So if your business receives a large tax-free key person benefit, what immediate financial mechanisms should that corporation consider beyond just continuing a salary to maximize the value of that tax-free cash for its principals while avoiding an unnecessary, fully taxable dividend? It turns a simple tax-free benefit into a really complex planning challenge.